Hello, and welcome to the Josh Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Josh Brown Podcast. I'm Philip Saunders.
I'm Dan Joss.
And today we're going to be talking about investing for the long run, or why does long-term investing work? So we can go either direction with this one.
All right, let's go in one direction.
Okay, that's a good point. So at this point, we have 100 years of S&P 500 data. How about that?
I didn't realize that.
I didn't either. I think the first few years were the highs were really high and the lows were really low, and then they brought some regulation to it, and now it's a little bit more regulated, but you know, the highs aren't so high, the lows aren't so low.
I wonder how many of today's S&P 500 companies were here 100 years ago.
I don't know. I would think none.
There may be a few.
Railroads?
General Electric. Mergers
Yeah.
would cover the name.
Well, sure.
Yeah.
Yeah. Companies got bought out, yeah. No, that makes sense.
Banks.
Banks? Yeah, that's true. Yeah.
There's some
I don't know what banks were around back in your day.
Wells Fargo.
Well, they're not around
1800s.
anymore. Oh, no, I was thinking Wachovia.
And so when banks merge, the older bank always has the name so that they can keep that long history.
Gotcha.
Yeah.
Gotcha. So that's what happened to Wells Fargo. Interesting. Yep. And then BB&T, right? Now it's Truist. But Truist is a new thing. I don't know. Maybe, I don't know. Cool. So we've got a lot of history. And our recommendation as an investor in the stock market is to invest for the long run.
Yep.
And so I did some scenarios and crunched some numbers, and ChatGPT helped me, of course. But two scenarios. One, if you start investing at age 20 and you have $10,000. I don't know where you got that $10,000 from, but you have $10,000. And then one, if you start with that same $10,000 at age 30 investing.
Okay.
And so this is at 10% annual returns.
Okay.
So about what the S&P 500 has done over its history. At age 60, if you start at age 20 investing, now you're age 60, you'd have around $452,000. But if you start at age 30 and now you're age 60, that would only be $174,000. I say only, but that's still a lot of money. It's still a great return.
Okay.
But it just goes to show you the difference in 10 years of returns, compounding returns.
Yeah, more than double.
Absolutely. Yeah.
2.5 times more almost.
Yeah.
And investor only invest often.
That's right. Yeah. Just every paycheck.
And 10,000 is a nice round number because you could say 1,000.
Yep.
Then you have $45,000 or $17,000.
Or, yeah, 1 penny. Have $45.
I think transaction fees would eat that up.
Yeah, no way. No way.
But about 1,000 a month.
Yeah.
Yeah, that probably at 20 is tricky, but you could say 25 and 35 and then 65.
Right.
Same number of years.
Yeah.
Yeah.
Yeah, it just goes to show you
the last few years of that compounding are the big ones.
Right.
So the sooner you start, because the dollar amounts are bigger, they're larger. So the sooner you start, the sooner you get to those big years at the end.
Right.
That's what they're doing here.
Absolutely. Yeah, there's the rule of 72. You take what your percent of return is. Let's say it's 10%. 72 divided by 10 would be how many years it ought to double, in the market. So it's kind of that idea. Like, in this scenario where you're age 20, it had those extra years to double and more than double your money. So,
right. So the last 7.2 years, whatever you have, doubles again.
Right.
Given average returns.
Yep.
Good.
Yeah. So, okay. So start early, and as you said, invest often as well.
And just make it automatic.
Yeah. So just set it to go from your bank account every
Although-
month.
I mean, it's easy for theory, but in reality, yeah, where does a 20-year-old get that $10,000?
Sure.
And we use those dollars, right?
Yep.
We buy a car.
Yep. That's what I was talking to my brother, a couple years ago now, but we were talking about the time value of money, right? Which this is the time value of money. Like, you invest $1 today, it's going to be worth more in the future.
Yep.
Versus that same dollar. Anyways, there's also this like time value of like your body.
Sure.
Like, there's certain experiences you can only do when you're younger. There's certain experiences you can only do when you're
Healthy.
middle-aged or whatever. Healthy. Yeah, that's probably a better way to say it. Because, yeah, that's true. Healthy is a better way to put it. But
Active.
But so those same dollars, like that $10,000, let's say, is competing for
Lots of
an
things.
experience. Yeah, that's a good way to put it.
Should I give this
Or a
away?
new
Should I spend it
car,
on me? Is there an emergency that happened that made it so I couldn't invest that month?
Yeah.
Yeah.
So to me, it's almost like it's the opposite of the time value of money. Like, that 10,000 is worth more today because if you're healthy, like, you can do these things, you can do these experiences, and when later on down the road you may be less healthy, less able to do those things. So,
Yeah.
Anyways, everyone knows that.
Those are part
but
of
I just think it's
lifestyle,
an
though.
interesting-
But let's just say you're earning. I think a few years ago, the average starting salary for a college grad was $50,000, right? So if you have a $50,000 lifestyle, then you can't do those things. But if
Right.
you've got a $30,000 lifestyle, then you can invest and you can do some of those other things.
Some of those experiences,
That's
yeah.
the point, is to
Yeah.
have margin in your paycheck so that you can always invest for your future self and get these returns
Yeah.
and
Also do those
do
other
some
things.
things.
Yeah.
Yeah. But if you get a big mortgage and a big car loan, then you limit your ability to do a lot of other things you'd want to do.
Right.
So
Yeah. You just handicap yourself.
that's
Yeah.
where we come in as planners, not just investment
Exactly.
advisors. How do we
Yeah.
maximize the joy or the contentment you get out of your salary
Yeah.
by valuing these things, whether your future self is valuable, but not at the cost of your present self.
Absolutely. Yeah. Yeah. I would echo that and say that, like, that some people are super savers and some are super spenders, and we try to identify which one you are.
And make
And
you
we
go the
help-
other way a little bit.
Yeah, lean the other way, exactly. Yeah.
Good.
So it's not always been easy in the stock market. There have been some downturns. 2008 was a big downturn. The stock market dropped almost 40%. And then also from 2000 to the end of 2002, it also dropped, 20,
40%.
30, 40% over that time.
What's
period.
interesting about that period of years was the S&P 500 was down 40%, but small cap stocks were only down one of those 3 years.
Interesting.
So diversification worked, having something that acts differently than the other things you have.
That's right.
Yep.
Yeah. So that just goes to show you the power of diversification.
And in 2008, everything was negative, even some fixed income.
Yeah.
And I remember that because we could tell based on the portfolio's return how much equity they had in that portfolio.
Yeah.
So 75 equity portfolio, 25% fixed income was down 30%.
Yeah.
Because equity was down 40, and a 50-50 portfolio was down 20%.
Yep.
So, and that's part of our job, is trying to help clients determine how much risk can they withstand.
That's right.
So that they can still stick with the philosophy in those periods. Because right here,
That's
you
right.
just said it. 2000. That's 6 or 8 years later was another 40% decline, and we'll have some more. Last year, market lost 20% in a couple months, and it recovered.
Yep.
So
2022, I don't remember what the numbers were, but
it's
was
minus
another
20%
tough
on the year, I
year,
think.
Mhm.
Yeah, so we'll see 20%.
It
We'll see.
bounced back.
We may see 40% drops
Yeah.
again. Because what we're doing is we're investing. And if you look at it as a business, pick any business, we're providing a service, or we're providing goods for sale, and sometimes things don't sell.
Yeah.
And they go to the discount rack.
Mm-hmm.
But you got to buy next year's inventory and start over again. So
Yep.
so we have better years than others.
That's right.
And investing should be
It
looked
varies year
at
to year.
a long-term thing. And that's the difference between investing versus savings, where I get interest on my income.
Yeah.
The risk that we assume gives us the ability to get that 10% return.
That's right.
The equity premium above just a regular interest income or a bond interest income.
Mm-hmm. Yeah, I mean it's similar to like an entrepreneur. When they start their business, they're taking on all that risk, and so if they're the one, if that business does succeed, then they're the ones who get all that reward.
Yeah.
Whereas if you go and work for an employer, you're not taking on so much risk, and so you a lot of times don't get the same reward as a successful entrepreneur would. So.
Yeah, and the markets, when we look at market returns 10%, that masks the 20 or 30 or 40% returns, and it masks the bankruptcies. So
the bankruptcies, what is that?
Well, companies go out of business
every
every year.
Yeah.
Every
Yeah.
year.
Mm-hmm.
So we like investing in the market as a whole because we give up the high winners and some of the losers, and we get the average returns, which are pretty good.
Yeah, absolutely. They are pretty good. Yeah. So so I guess in summary, maybe we'll go to behavioral advantage and common pitfalls. We'd say invest for the long run. What would you define as the long run?
The way 10, 20 years.
10, 20 years.
Your future self.
Your future self, yeah.
Yeah.
Well, that's...
For many, that would be retirement, and retirement itself could be 40 years.
Yeah.
Right? If we retire at 60, we've had clients live into their hundreds, or even if you work late into your 70s, you still have 30 years of, that's long term.
Yeah. Yeah. So invest for that person, not for tomorrow.
And for our older clients, they're investing for their children and grandchildren. That's long term.
Yeah.
So, who really cares about what happened in the news yesterday?
That's right.
It doesn't impact.
It doesn't impact 60 years.
It impacts short-term volatility, but not long-term market returns.
Mm-hmm. Absolutely. Yeah. So
stick with it. Do it regularly.
Stick with it. Diversify. Don't get too risky. Set an investment policy.
Yeah, and investment policy would be all of those things you just talked about. How much risk? What does diversification mean?
Yeah. We set investment policies with our
long-term
clients, like defining those things. But, even if you're an individual investor, setting that for yourself and saying, this is what I'm going to hold myself to and be accountable to it. And don't let your emotions dictate what you do, which I think goes for probably all of life as well, but certainly in investing. So if you have any questions about investing for the long run, send them in. If you have any questions otherwise, give us a call. We're here. So I think that's it.
See you next time.
That's right. See you next time. Bye.
Thank you for tuning in to today's episode of the Joss Brown Podcast. If you'd like to see more episodes, visit our website at jossbrown.com.